Talking about the first presentation for the day today, COVID-19 and anti-fragility of the Indian startup ecosystem. The word anti-fragility, for those who may not be aware, is a nature of a subject which allows it to thrive under stresses. The idea is not just to survive, but also to look at these external circumstances and to take it into an opportunity to do something different, which makes you stronger and better for the times to come. And that is one core thing that we have seen with the Indian startup ecosystem, where the entrepreneurs have definitely borne the brunt of COVID-19 in terms of all the business pressures and the business discontinuity which came into play. But more often than not, they have responded very, very smartly and very frugally to be able to understand what is the situation and how to react to it, to the point that today we have some really interesting companies coming out of India. We have seen a growth which we were not expecting in terms of the business as usual. If COVID had not hit, there are a lot of companies today which may not have been unicorns or would not have seen this business traction for at least 2 to 3 years down the line. Overall, the takeaway has been that the digital transformation has accelerated across the country, not just on the business side, but also on the consumer side. Now, why do we say this? So let's look at a couple of pieces from the report itself. As we built out the report, what we wanted to do was we wanted to make sure that there is an in-depth understanding in terms of what has COVID-19 done from an impact perspective. We wanted to see this impact not only in terms of overall ecosystem, but also more sector and specific sub-verticals which are there to see what is working and what is not working. And finally, what we wanted to gauge was that what does the future look like for the ecosystem. For this particular report, the definition of a startup is a technology product company which is less than 10 years old, which has its office in India in terms of core product development. It could be registered anywhere in the world, but the core product development happens in India. It is, of course, active. It is not an idea stage company. These are companies which at least have a prototype or an MVP that they have taken to customers. But most critically, there is an element of innovation involved in the process. When we started the year 2020, there's a lot of momentum and upbeat in the ecosystem. We had closed 2019 with about 9 unicorns. It was one of the biggest years in terms of funding. We were overall doing pretty well in terms of number of active startups. We had about 38,000 startups active in the country. The 4-year CAGR was about 17 to 18%. And with 26 unicorns, we were the third largest unicorn ecosystem and the startup ecosystem in the world. Not just that, what we also had was we had about 400 plus unique active institutional investors in terms of VCs, corporates, in terms of private equity funds. We also had about 520 plus active incubators and accelerators, again the third largest in the world. And we had close to about 100 plus startups which would be called as potential unicorns. These are companies who have raised more than $50 million in cumulative funding and also are showing extremely positive business metrics. From a corporate perspective, 2019 was also a record year where we had about 170 plus corporates participate in India, a growth of about 15 to 18% year on year. And these corporates were not only investing in companies, not only acquiring them, but they were also deploying a lot of open innovation models in terms of corporate accelerators, corporate incubators, or partner programs. Now, that being said, when COVID-19 came in, there was a serious business discontinuity. We did a survey with the startups in terms of understanding what the impact was, and close to 41% startups reported that they had a negative impact on the business. This impact was more severe for companies which were at pre-seed stage, which had basically not raised too much capital. For the companies who had raised capital in terms of growth stage or late stage capital, the impact was a bit lesser simply because they had cash in the account. They had money in the bank, which allowed them to have a significantly longer runway and to think through what could be done. 44% of the companies, which is typically the unfunded companies and the seed stage companies, reported they only had cash flow for 6 months. Overall, what we saw was that companies wanted to raise capital, but almost 52% reported that it was becoming very difficult to raise the capital. And there are many different reasons in terms of why this was happening. Fundamentally, COVID-19 is something none of us had ever thought. Right from a customer to an entrepreneur to an investor, everybody was trying to first survive in terms of as individuals, then as businesses, before they went on about their daily work in terms of executing the mandates that they had taken earlier in the year. It was a time of ambiguity, it was a time of uncertainty, and everybody was trying to make sense. This was extremely visible when we look at investments. Over the last few quarters, what we saw was the quarter two of 2020, which is from April, May, and June of the year. We had the least amount of investments coming into the country. This is a prime example where all of us decided not to take any new decisions, but rather to just ensure that the shop is open in the country. A similar piece was in terms of different stages. One of the biggest investment stages and the most critical stages is the growth stage and seed stage. Both these are extremely critical is purely because it creates a pipeline for future. The late stage funding also dropped down because this is where a fair number of companies end up raising big ticket investments and nobody was ready to cut a large size check. That being said, when we looked at COVID-19 as on September of 2020, what we saw was there was a very mixed impact. There were certain sectors in terms of enterprise tech, education, gaming, life science and healthcare, which have had a positive impact during this COVID-19 period, where the risk of a business going down reduced significantly. Then we had certain sectors like media, entertainment, retail, BFSI, agriculture, consumer internet, which had a mixed impact from a sector perspective. Some of these subsectors were growing really well. Some of the sectors were thriving steadily. They were coming back to recovery part. Take, for example, retail. In retail, while the traditional e-commerce went down, the grocery business went up significantly. And that sort of became tailwind for a lot of companies for their growth. This is a pattern that we saw not just in India but across the world. And then finally, what we saw was that there were sectors which have been negatively impacted by COVID-19 to the point that they still haven't recovered from it, and there would be certain time from a recovery perspective. These are businesses like mobility, in terms of companies like Uber or Ola, where people are not traveling and consequently the business is down. Or take, for example, real estate and construction, which does not move forward because the supply chains have completely been broken because the labor has gone back to their home cities instead of working where the demand really is. Now, that being said, we went a bit more deeper to understand what has been the positive impact, what has been the medium or the negative impact on the industry. When we talk about positive impact, one of the biggest positive impacts we have seen is in terms of education. Interestingly, as everybody went into lockdown, we started working from home. It also meant that kids, children, and professionals who were enrolled in education institutes also had to study from home. There was a huge surge in terms of demand for online education across different levels, right from kindergarten to K-12 to college and university to special certifications that people could go after. Most critically, what we saw was there was a significant jump in terms of free versus paid. More and more consumers were ready to pay for online education. A fundamental metric extremely critical for a business to survive is in terms of generating these revenues for the customers. And something which was available for the longest time but was not able to pick up that you can actually pay for an online course and your advantage happened during this particular period. This also translated increasing from the investors and corporates into the education startups is because what they saw was real business metrics from a growth perspective. On the similar line, when we look at digital health as an inflection point, this is again a story where India as a country has had huge healthcare needs. We are a country of 1.3 billion people. However, the income distribution of the company is extremely different compared to, say, a West or to China. We have a pyramid structure where a small percentage of India can be compared to the Western economies or to Japan in terms of income segments, but we have a large pyramid at the bottom where there is a demand for healthcare. At the same time, the price points don't really make sense. That being said, what also happened was there was a huge shift in regulation. The government of India ended up coming out with regulations which made telemedicine possible. Again, a scenario where telemedicine was active in India for the longest time, but the regulations only allowed for it to really grow during this particular period. We saw companies like Practo, which saw about 500% growth in online consultation. We saw companies like Fitter, which is all about health and wellness, have a 2.5x growth in terms of their revenue, about 25% month-on-month growth. The interesting piece is that as the COVID-19 impact reduces in terms of the economies opening up, these companies are still not seeing a significant drop in terms of the usage. The usage continues to be steady in spite of the economies opening up and people starting to get back to work slowly. One of the core pieces and lesser known bits about India is that this is not just a country for consumer startups. While we have companies like Flipkart, Oyo, Ola, which are more popular across the world simply because they have raised a lot more capital, India is also a country of B2B startups, where about 26% of the startups in India today are building solutions for the world. This is what we would call as the enterprise tech. And if we divide this into two groups in terms of technology focused on large enterprises and technology focused on small and medium businesses, what we saw was both segments saw an increased acceleration in terms of their adoption. All of you are pretty familiar in terms of how corporates reacted in terms of focusing more on adoption of digital technology. That being said, what we did also see was a similar approach by small and medium businesses to go digital. This is a segment which has typically been almost a fruit which was unreachable for any investor or entrepreneur for the longest time. Everybody saw opportunity, but the biggest hurdle was adoption of technologies. This is where we have seen companies like Khata Book, which is a very India-specific, a unique solution, which allows you to maintain your books in terms of your daily business grow significantly. It is one of the fastest growing B2B companies in the world today, purely on basis of the product and the whole adoption of digital technologies by small and medium businesses across the country. Coming to something like lending, it was a sector which was severely hit. And this is what we saw and found to be extremely interesting when we look at BFSI. What we found in BFSI as a segment, which is banking, financial services, and insurance, was that certain elements like lending went down. The core reason of lending going down was predominantly because the lenders did not want to open up their loan books because the borrowers, which is SMBs or consumers, they weren't really sure if they would have the ability to pay back. This was again a time of uncertainty in terms of saying how many businesses will shut down, how many businesses will survive, and people chose to be cautious in terms of giving fresh loans and investments. That being said, what we are seeing is that the lending segment is coming back steadily. The third quarter, which is in the quarter from July, August, September, is somewhere where we have seen the return coming back to almost 0.8, which is 80% of the pre-COVID levels, by end of the year. At the same time, we saw a huge growth in elements like payments. Now, for those of you who may not be aware, India went through a demonetization exercise a couple of years back. And this was the first scenario where Indians who were used to cash economy had to suddenly switch to a digital economy in terms of making payments. While we have had that friction a couple of years back in making a shift, what COVID-19 only did was it accelerated adoption of online payments for smallest of consumer needs. What we have seen is the volumes have increased, what we have seen is the value has increased, but most interestingly is the average transaction price. And this is where we have a beautiful range today in India. What we are seeing is that individuals are able to make payments as low as 10 rupees, which would be maybe say about 10 to 15 cents for a transaction, a US cents for a transaction, to something which goes into a couple of hundreds of thousands of dollars. This is a beautiful part, not only in terms of payments, but also in terms of segments like wealth management and savings. There's a company in India called Zerodha, which is an online brokerage company. If I had to give you an example, you may compare it with a company like Robinhood in US. It's not exactly similar, but somewhat in the same space. What Zerodha saw was that during this period, they had an increased usage from the retail investors in the country. More and more Indian individuals, consumers, citizens decided to use the money that they had on hand in terms of savings, which the savings had increased because they were not spending money anywhere, and wanted to deploy this into creating wealth for themselves. And one of the most beautiful things which has happened in the Indian ecosystem overall is during the quarter 2 and the quarter 3 of this year, when most of the institutional investors like mutual funds, hedge funds were cutting their positions in stock market, the retail investors started to get in and started to acquire stocks and started to make these investments. And interestingly, a whole bunch of wealth creation today in India is not with institutional investors but with retail investors. This is a fundamental shift again, where something like wealth management and brokerage, which was again underrepresented industry in the country, has grown out beautifully. Now, while we speak of good things, there are also segments where things have not been really great. Travel and hospitality, for example, is still recovering. We are far away from pre-COVID levels, but the good news is that we are seeing a steady increase in terms of online bookings. Air travel has increased in India, and consequently, the startups in this space are also seeing increased traction. What we anticipate is by end of this year, close to about 35 to 40% of the travel and hospitality business will come back to its pre-COVID levels. When we look at mobility, we saw mixed results here. In terms of mobility, what we saw was while people were not really traveling and they're still not traveling as much, there has been a steady return as people go back to work. We also saw the holiday season, also the wedding season in India, which had people travel a lot. The expectation is that by end of this particular year, close to 40 to 50% of the demand will return. That being said, until the vaccine is not back, it will still take maybe the whole of 2021 for us to reach pre-COVID levels. The interesting part, however, is that while the demand has come down, the burns of the companies have also come down. To give you an example of these particular burns, we'll show you a few case studies as to how the economics have changed because of COVID-19. But just to summarize before I get into that, is that we have seen a huge mix of impact of COVID-19, elements like education, online insurance, telemedicine, telecommunication, media entertainment, all have seen a significant growth in the country during this particular period. When we talk about e-commerce, we're talking about groceries, which have grown significantly. At the same time, elements like fashion and regular digital commerce is coming back slowly. At the same time, what we would see is that certain segments, and this would be the minority in terms of mobility, travel, and hospitality, return to their pre-COVID levels sometime by mid next year or end of the year. A key reason for this whole change has been the response that the startups took. To give you a few examples, what we saw is the entrepreneurs focused on reducing the cash burn and focused on better unit economics. What they did further was they looked at new opportunity areas which got opened up where they could reuse their capabilities. They focused on pivoting to these opportunities and seizing at the business opportunities. We also saw companies who were offline first brands moving into our online first brands and growing forward. And most critically, we saw diversification in product offerings. For sake of time, I'll not go into each of these particular examples, but I'll just show you maybe two examples to give you a perspective as to what's really happening. One of the companies which has been in India is a company called InstaMojo. What InstaMojo does is it helps SMBs and freelancers manage their finances better in terms of invoicing their customers or in terms of selling their particular goods. This company was consistently making losses in terms of, before COVID and also through COVID for some time. But what we have seen is that because online transactions increase, because the online payments and online adoption of commerce increase, the company is today in a positive run in terms of number of customers they are serving, the amount of GMV in terms of the business that is just flowing through them, the revenue that the company itself is earning, and most critically in terms of the margins that they have. Furthermore, because this company works very closely with its customers, it has also seen an increase in terms of the loans and disbursement of these loans that they end up giving out to customers. A complete scenario where what they did was they leveraged their existing products and focused on better deployment by reducing the cash burn and only focusing on economics. Another great example is of a company called Zomato. Zomato is a unicorn in India. It is a food delivery company. During this lockdown, a lot of people were stranded away from their families and they had to sort of figure out how to ensure that they get the meals. And this would be people like me who don't know how to cook. In this scenario, the food delivery companies became our saviors in terms of ensuring that we get to eat something. But most critically, what also happened, it gave these companies a chance to rethink their business model. Zomato was a company in a food delivery space which is highly competitive in India. It is known for a lot of discounting. And the sad part is that every time they would sell something, they would actually make a loss and not make a profit. That being said, during COVID-19, because there was a natural demand which was coming in and it was a real need versus something which was, a good thing to have, it became almost like a must-have. What we have seen is that Zomato has been able to improve its economics. Their revenues have been increasing, their EBITDA loss have started to come down compared to last year. And what we believe is this company will go for an IPO on a much stronger note in the coming 12 to 18 months. And now this is just an example of a small company and a large company in terms of how they used better economics and reducing their cash burn to improve the business metrics. For more such information, we would be sharing link of the report that you can download and study in detail. We have given a lot more examples in the report for your reference. Now, very quickly, while all of this was happening, what has happened as on date? So this report, which did the study till September 2020, found some very interesting trends happen. Number one, we saw about 34 unicorns being active in India. About 8 unicorns were added as on September 2020. Currently, in terms of, as we talk on 17th of December, this number is about 10 unicorns in the year 2020 and 36 overall. 5 companies became unicorns during the pandemic time. This includes a company like Razorpay, which is in payments, a company like Postman, which is into enterprise tech, a company like Unacademy, which is in education, Techion, which is into OEM, automobile showrooms, and Nykaa, which is a beauty brand, a B2C brand in India. What we have also been seeing is that the investments are returning. The quarter three investments are significantly higher than what we saw in quarter two. In quarter four, we are already on track in terms of these investments level being higher than quarter three. What we also saw was the recovery across the different stages. We saw a recovery in seed stage, we saw a recovery in early stage, and also most critically in the late stage. Typically in any ecosystem, it is the late stage which has a significant portion of investments coming in. It is also a reflection of the quality of the business that the investors are able to cut larger checks. That being said, one of the things that we are extremely excited about is the number of new companies which are getting funded with each particular quarter. Now, the reason this is important is because this gives a reflection on the quality of the pipeline, which is the top of the funnel as to what are the young entrepreneurs or the new entrepreneurs really doing. While we saw a drop in quarter two, when only 23% of all the startups funded were new companies, in quarter three, this number is already at 32%. By end of this particular year, we do improve this number to increase significantly. For us, this is a real reflection that on one side, you are seeing late stage investments coming in, where investors have been betting on companies which are already existing versus investors also betting on newer companies. Gives you a good view in terms of how the ecosystem overall is still promising for global investors to be active. Finally, mergers and acquisitions are a very critical element for any ecosystem. Overall, India does lag behind China and US and Israel in terms of number of exits. This is simply because the nature of business in India is very, very different from these particular economies. That being said, what we're also seeing is that the M&A is back on recovery. This is an extremely critical point because there's also a reflection in terms of the increasing participation of corporates in terms of their decision making and them returning into the ecosystem to be active and to be able to take up these particular opportunities. All of that being said, the next question comes is that what can we expect in the coming weeks and days and months going forward? We are pretty optimistic. We wrote this report in the month of September. Again, we have had a chance in October, November, and December to see how some of these predictions are coming true. The first one was that we anticipate that the funding levels will return to pre-COVID levels by the month of quarter two, during quarter two 2021, which is about 6 months from now. We are completely on track on this. The quarter four, that is the month of December, which will end, we would be seeing a lot more funding happening in India compared to the previous quarter. Similarly, the number of startups who will get funded is something we anticipate will keep increasing quarter on quarter. The seed and early stage is where a lot of activity will happen in India, predominantly because the late stage investments have unlocked a lot of early stage capital. Early stage investors have been able to get an exit, and they would be going forward in terms of these deployments. I was just reading a report which showcased that the third largest incubator and accelerator in the world is today now active in India, with a portfolio of about 150 plus companies that they have invested in. Overall, out of which about 100 companies were invested only in the year 2020. From a jobs perspective, a very key indicator for any economy, the indirect jobs, will reach pre-COVID levels by sometime mid of 2021. The reason this is critical is because for anybody to build out a business or for you as a corporate to work with them, they would end up requiring secondary, tertiary workforce in terms of executing a lot of those engagements. And this indirect workforce is coming back online rapidly. And of course, given India's talent, we don't see a dearth of demand, a dearth of supply for any business to be executed. Most critically, what we have seen is that the investments in engineering or the direct workforce has more or less been very, very neutral during the last 12 months. Entrepreneurs, while they have been focusing on reducing the cash burn, they have not really cut down on their engineering teams. Whatever layoffs that we saw were predominantly in the business development, customer support, logistics industry early in the year, and those are the jobs which are now returning overall. Finally, what we believe is that given the way Indian ecosystem has reacted, given the numbers that we have seen in the month of October, November, and December, we are definitely on track where the Indian ecosystem will continue to be third largest, with about 60,000 plus companies active in next 5 years by the end of 2025. We believe that there will be about 100 unicorns which will be active in India. When we wrote this report, we anticipated the number to be about 34, but we are already at 36. And in that sense, it does give us a lot of confidence in the projection. But overall, as an ecosystem, this number should touch about 100 by the year 2025. Now, as a last point, what I would maybe want to leave you with is that the ecosystem has been extremely aggressive in terms of its reaction to COVID-19, in terms of looking at this not just as something that you have to survive, but you have to use to your advantage and you have to thrive and open up new opportunities. With each passing day, the sentiments are improving. Investors, corporates are increasingly participating in the ecosystem. And that is something we'll hear more with Ambrish and the panel discussion which is to be followed. Thank you so much. Back to you, Prasanna.